So here's why investing over the next 10 years is not going to make you that much money. Now, when it comes to making predictions, it's pretty much impossible, unless of course you're a magician, which is why I want you to think of a playing card. You're thinking of the Ace of Spades. No, statistically most people say the Ace of Spades, but that's why when it comes to making predictions, they're not all that valuable because predictions are like opinions. Everyone has one, but the truth is not all predictions are created equal. Just this week, there was a company by the name of Vanguard that put out their estimates for what they think will happen to investors over the next 10 years, and the results are kind of disappointing. Now you might be thinking, Vanguard, why would I take financial advice from a company that guards vans? Vanguard has probably one of the most respected names in all of finance, and that's because it was started by a man named John Clifton Bogle, and he was pretty much a genius. You know how Robinhood gets all the credit for introducing zero-fee trading to the world? Well, that trend was originally started way back in August 1976, the same time as when Steve Jobs was just starting Apple inside of his garage, the same time as when Sylvester Stallone introduced Rocky to the world, and the same time as when the average cost of a new house was only $43,400. Yeah, the good old times. But that was exactly when John Bogle invented the concept for the index funds, and the idea was super simple. Rather than trying to compete with professional stockbrokers and hedge fund managers and paying them a ton of money to do it, why not get a bunch of people together, put all of their money in one place, call it a mutual fund, and invest all that money across the entire market. Now, when the fund originally launched, it started with $11.3 million, which was extremely short of the original goal of $150 million. But that fund became extremely popular, extremely fast, and in the first 20 years of its performance, it grew at a yearly compound rate of 53%, and that changed retail investing forever into what it is today. So the idea that we have of investing now, where we put money into something and then have it grow into something more in the future and have that strategy be accessible to everyone, was Vanguard's contribution to finance and John Bogle who led the way. So what Vanguard says will happen to the economy over the next 10 years matters a lot, and that's what I want to share with you in today's video, so let's get right into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the history lesson. I love stuff like this because it makes me appreciate the history of it and where it comes from and all the different ways and tools at our disposal to make money with. Things that our parents and grandparents would have only dreamed of back then. But here we are today like,
Robinhood doesn't let me buy IPOs and Bitcoin in my state.
First, I want to say I'm not trying to convince you to buy or invest in anything in this video. This is purely for educational and entertainment purposes only. And at the end of the day, even if I'm using highly respectable sources, this information may not be 100% accurate because no one can predict the future. But as long as you know that going forward and you understand what's going on in the world, hopefully it'll encourage you to invest in the long term, just like Mr. Bogle would have wanted us to. So let me share with you their 10-year outlook, and then I'll share with you what they're saying about this year. But first, a quick word from today's sponsor. When it comes to work, communication is key, even if you don't have a writing job. I believe that communication, regardless of whether it's spoken or especially in today's world, written, is one of the most powerful tools we have for building strong relationships. And that's why I'm so excited about today's sponsor, Grammarly. Grammarly is a digital writing assistant that helps over 30 million people write more clearly and effectively every single day, including myself, because a huge portion of what I do here on YouTube is all about researching, writing my videos, emailing people that I work with, and that means my message has to be on point, my spelling is accurate, and most importantly, I have to get the tone right, which means sometimes I have to be more confident, other times I have to sound more positive, and sometimes, because I want to save time, I have to be more clear, concise, and direct. Now, Grammarly has a free version which helps with suggestions, grammar, spelling, and clarity. You can even set goals with parameters like your audience, formality, and intent. But if you want to take it to the next level, Grammarly also has a premium version which has one of my favorite features, tone suggestion. If you want to sound more confident, it can help you do that, and it will even rewrite whole sentences for you depending on what you're trying to do. Grammarly also integrates with your favorite tools on the web, in your emails, in the workplace, and at home. So if you're ready to become a more effective communicator, you can try Grammarly for free and even upgrade to the premium version for 20% off using my link down below at grammarly.com/Andre, or just click the link in the description below the video. Thank you, Grammarly, for sponsoring this portion of the video. Now let's get back to it. So here's their 10-year prediction chart. It's based on something called VCMM, which is Vanguard's capital markets model. This is a simulation engine that uses a bunch of complex economic variables to give us an estimate about the future. And I'm going to go through this with you together so I can show you whether this is good or bad. Now, on the left-hand side, you'll see the return projection. This is what their guess is as far as what they think will happen to all the different equities and stock market. But on the right-hand side, you'll see the median volatility, and you'll notice that the numbers here on the right-hand side are a lot higher. Now, what is this? The median volatility just measures the expected return and how far it can, one, under from their prediction. So for example, US value right here, which probably refers mostly to blue chip stocks or dividend stocks like Johnson & Johnson, has a median volatility range of 19.8%. Now this does not mean that this sector is going to go up by 19.8 or go down by that much specifically. It just gives us a range from which it can fluctuate from their estimated projection. Now here's a really interesting chart I found. This is a study of 3,700 stocks that they did, and what they found was the more valuable and the bigger a company is, the less the likelihood of it having a 100% rate of volatility. So a mega cap stock, for example, that's worth over $200 billion will never have 100% rate of volatility, meaning it's never just gonna double or go to zero overnight because it just can't. It's too big. But a smaller company can, because it takes a lot less money for that stock to double or triple. A small cap stock might not be profitable, so people speculate, they invest their money in it, and then when it becomes profitable, they can double that money because it's a lot riskier, so it has a higher median range of volatility. That's why small cap stocks have 22.9% median volatility. It's not 100%, but it's a much bigger range. Now, even more levels of uncertainty is the emerging market at 26.4%. But the point is, the greater the risk, the bigger the up and down waves will be. But overall, the US equities market, which is this one right here, that represents the US stock market, they predict will be between 4.7 to 6.7% returns per year over the next 10 years. Now, this is actually not good, because if we look at the last 10 years from 2012 to 2022, the stock market has averaged 12.4%. So basically what Vanguard is saying that over these next 10 years, the stock market will do about half as good as it did in the last 10 years. So that's pretty disappointing. But the good news is there is something they predict will actually do better than the US stock market, and here's what it is. So here's an alternative. Please understand that I'm not trying to convince you to buy or invest into any of these. I'm not even sure what I want to do given this new information yet, because I'm processing this just like you are, and I didn't know this before making this video because I'm not an expert. So according to Vanguard, they predict that the best index fund that will outperform the US stock market is going to be the world equities, aka the stock market of the world, excluding the US market. Now hold on a minute, what the hecking stock is that? Is that actually a thing? The whole world as a stock, excluding the US? I'm glad you asked. There is such a thing. The ticker symbol on Vanguard as the index fund version is VEU. Now if you want to use a simple brokerage like Robinhood that I'm using, they're not sponsoring my channel, I've just been using them forever, that would be Vanguard FTSE All World EX US ETF. It's a mouthful, but this is what Vanguard thinks will outperform the S&P 500 over the next 10 years. Now let's take a look at bonds or fixed income. This one is really important, especially if you're getting older and you're just getting ready to retire and you're like, nah, miss me with the stock market stuff. I just want to preserve my money. I don't want to risk it in the market. What's interesting about this graph is that the interest rate or the yield on these bonds is comparable to the stock market, but the volatility is almost half. So it's actually less risky. In fact, the high yield corporate bonds are predicted to make anywhere between 6.6 and 7.6% return. And that means it's actually going to beat US stocks over the next 10 years, which is pretty interesting. Now, hold on a minute. You might be asking, what the heck are high yield corporate bonds and what stonk is that? And that is VWEHX. That is the index fund version. And as far as the ETF version that you can buy in a simple broker like Robinhood, I wasn't able to find, but I found a close equivalent, which is HYG. Now, when it comes to high yield corporate bonds, they are sometimes known as junk bonds. This is because investors get paid a really high yield or interest rate, but then there's also a much higher risk of default. Now the question is, why would anyone want to buy these junk bonds? They sound exactly like what they are. They're junk. This is because these junk bond index funds or ETFs are not just buying one junk bond from one company. That would be extremely risky. Instead, it takes that pool of money and it diversifies it across different sectors of the market to buy the junk bonds from many different companies. And that's what lowers the risk and the volatility to almost half of that of the stock market according to Vanguard. Now, how does it even work, right? Like, one risky thing is risky, but if you add 100 risky things, they're a lot less risky. Doesn't make much sense. It's counterintuitive, and it kind of reminds me of the birthday paradox, which states, in a room of 23 people, there's a 50% chance that 2 people will have identical matching birthdays. Yeah, it's crazy. Think about that. Now, in a room of 75 people, there's a 99% chance that 2 people will have identical birthdays. That one's gonna fry your mind when you look it up later. It's called the birthday paradox. The point is, says, according to Vanguard, these high-yield corporate bonds or junk bonds are set to outperform the US stock market over the next 10 years. Doesn't mean it's going to happen 100% for sure, but according to Vanguard, they believe it will. I'll have to do a lot more research about this because I have never invested into junk bonds, but they sound really interesting and terrifying at the same time. But all of this stuff is 10 years away. That's a long time from now. What about today? Here's what they're saying will happen this year. As far as the United States is concerned, Vanguard says that on February 1st, our favorite Papa Jerome Powell is going to increase the federal funds rate between 0.25 and 0.5%. The new range will fall between 5 and 5.25%. But Vanguard says the increase won't matter as much as the peak and how long it's going to stay there. Now, according to Vanguard, they predict that the Fed will target this specific range for the rest of the year, which is hopefully good news for the stock market because we don't want the Fed to raise their rates even more. Vanguard also believes inflation is going to fall below 3% at the end of 2023, which is good news, but it's still a little bit higher than what the Fed wants to see. They also think unemployment's going to go up to between 4.5 and 5%. Right now it's at 3.5%, which means more layoffs are probably coming, and they estimate the odds of a recession this year at 90%. And remember, a recession is anytime you get two negative quarter GDPs back to back. Doesn't matter how negative they are, just negative. Overall, please remember that this is Vanguard's prediction based on pretty complex models, but that does not mean they're going to be right. 10 years from now, we could find out they are extremely accurate or extremely wrong. Either way, at the very least, you saw a bad card trick and you learned about the birthday paradox. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stuff. Links are all down below. Go track them automatically with a spreadsheet link down below in my Patreon. I would love to see you back here on Monday, Friday, sometimes Wednesday. Love you. See you soon. Bye-bye.